Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. In today's show, we're going to look at the central bank's actions over the past couple weeks and really year for that matter, and discuss the impact on markets, expectations for 2023 and beyond, and ways to think about positioning your portfolios using ETFs given the environment that we're in. Before we get started, a quick reminder, we're not providing you any advice or investment recommendations. Today's episode, like all of our episodes, is around providing education around investing and using ETFs for Canadian do-it-yourself investors. With me today, I have my friend and colleague, Alfred Lee, joining me for our last session of this year. Special thanks to Alfred for being such a huge part of Market Insights this year. We really appreciate all your expert insights. So it only felt right to finish with you as our guest. Alfred's an investment strategist and portfolio manager with BMO ETFs. Before we get started, another quick reminder, if you haven't already, please check out our YouTube channel to watch any of the 100+ videos that you may have missed. Remember to subscribe and ring the bell so that you're notified as future episodes go live. So for today's 1-minute update, I thought I would take more like 3 minutes to review sort of the overall ETF market debrief in terms of ETFs for 2022 to give you some insights into how investors reacted to the market. So here's a report on this slide just showing the overall growth of ETFs in Canada over the past 15 years or so. And you can see just the enormous growth in this investment vehicle. And this is really a testament to the many benefits that we have been discussing every week on our channel. And what's interesting is that even with really volatile year and choppy markets, you can see, of course, the overall AUM here is down over the year, which is a function of markets. But what's really interesting is that it had no impact on the speed at which new products are coming to market. This is not slowed down at all. We had 15 launched in November alone. So there's now over 1,050 ETFs here in Canada for you to choose from 42 different ETF providers. So again, just giving you that precision to really target specific areas of your portfolio if that's what you would like to do. On this slide, we are showing sort of the overall ETF ecosystem here in Canada in terms of where the flows have gone across ETF providers. So you can see that BMO and Vanguard are in the lead in terms of new flows this year. And what's also interesting on the right there is the top 3 largest ETF providers account for almost 70% of all assets in Canada. So definitely, 42 different ETF providers, but very consolidated in those top 3, which I thought was interesting. Lastly, I just wanted to show the flows. This is as of up to the end of November. Showing you that fixed income is definitely the clear winner this year. And I think within there, it's really cash alternative ETFs that have been in the highest demand this year. Given people are having trouble stomaching the volatility in the markets, we saw cash alternative ETFs gather $7 billion in assets. And it's the first year in a long time that fixed income ETFs have outpaced equities. I think the last year was 2019. Since the markets have been on a tear, people have been really looking at equities, but we saw that shift this year. We also saw this year crypto really losing traction, numerous controversies, of course, FTX is the latest. But to put this into perspective, the AUM of crypto assets dropped to 1.8 billion as of November, but at its peak in 2021, AUM reached 7.5 billion. So people have really been losing confidence in this space. Overall, we've seen about 28 billion in flows year to date as of the end of November. So again, this is a great testament to the effectiveness of ETFs as a tool. So that's sort of the 2022 ETF market debrief. Let's get to the topic of the day, the central bank's fight against inflation. So over the past 2 weeks, we've seen more rate increases from central banks, capping off really an unprecedented year in terms of rate hikes. So Alfred, walk us through what this year has looked like as the central bank's really trying to cool an overheated economy here.
Yeah, it's been a crazy year for sure. This is something we haven't seen in a very long time. Not only have we not seen, interest rates hiked at such a quick pace, but just the amount of rate hikes we've seen as well. I mean, it's been very long since we've seen, rate hikes outside of 25 basis points. We've seen 50 basis points, 75 basis points, 100 basis points. So very unique year. It's been very hard for the markets, both on the equity side and the fixed income side. But in terms of inflation, I mean, just to go over, why we see inflation. Obviously, inflation is caused when demand outstrips supply, and obviously this round of inflation, in recent years, was caused by the pandemic. So as the economy came to a standstill, governments essentially tried to counter that by using fiscal policy and monetary policy, which I think was the right response. But on the flip side, when the economy opened back up, people started spending more. Supply was not able to keep up with demand, so that's why we're essentially seeing inflation at this point. So the good news is that when you look at inflation, real rates is something that we're keeping an eye on. So that's essentially the difference between a 2-year bond yield in the U.S., for example, and the CPI number. So as you can see right here, even though it went pretty negative earlier this year, the good news is that it's becoming less negative. So as that becomes more and more less negative, I could say, I guess, and eventually if it does turn positive, I think that's going to be a very positive signal. But overall, the good thing is that it seems like all the countermeasures that central banks have been doing this year is having an effect. So that's definitely a good sign for inflation eventually coming under control.
All right, you beat me to my next question as to whether this was actually working and if they're having an impact on slowing inflation. So they are working. It's not to be determined. It is having an impact.
Yeah, I mean, it definitely seems like it. I mean, when you look at CPI I think is the most common measure that a lot of investors are looking at. So when you look at CPI, I do believe there are some drawbacks in using that number. One, it's a basket that may not be reflective of a typical household in both the U.S. and Canada. But also when you look at CPI, when you look at the numbers, so mortgages is a good example where if you bought a $1 million house and you bought it at a mortgage of rate of 2%, and now you have to refinance at 5%, 6%, maybe even higher, your costs are actually going to go up rather than down. So that's actually going to make inflation look as if it's continuing to go up. But overall, anecdotally, when we look around, one data point that we often bring up is the cost of shipping, a cargo container from Shanghai to LA. That's essentially back to pre-COVID levels. Also, when we look at, what companies are saying, so Nike, Columbia Sportswear, something closer to home has been Canadian Tire. They're all reporting that, inventories are starting to build up. So you got to figure that over the long haul, that's going to be disinflationary because eventually they're going to have to start cutting prices. So on the goods front, inflation definitely showing signs that it's starting to abate. What's a little bit more concerning is that its services has been a little bit more resilient. And the reason why is because, I think, in addition to the mortgages, we also have, things like hotels, restaurants. These are things that we haven't done in the last 2 to 3 years. So everybody's trying to do, trying to get, make up for lost time and book all the vacations, go out to the favorite restaurant. So I think, over the long haul, maybe in, as early as spring of next year, I think that inflation on the service front is going to start abating as well. So the good news is that, inflation, even as measured by the CPI, is trending in the right direction at this point.
Okay. And 2 weeks ago, we saw Canada increase by 50 basis points. This week, the US announced. In terms of those actual statements that they make, there's a lot that can be gleaned from that. What do you take from those two in terms of expectations or what we can expect in the future? And what's the dot plot telling us?
Yeah, so a lot of information. I think in Canada, I mean, we haven't gotten the latest inflation number yet. That's still to come, and I believe it's next week. We got the CPI out of the US earlier this week, which was trending down, came in lower than expectations, which, was a positive sign for the markets. But overall, when you look at what has come out of the recent Bank of Canada and the Fed meeting, the big change in the narrative has been it seems as if they are open to reducing the pace of interest rates and maybe even opening the door for a pause in interest rates, which is something that we've been calling for, over the last couple of months. We've been expecting that the central banks potentially take a pause at some point in the new year. And the reason why is because when you look at the impacts of higher rates, it takes a long time for that to trickle into the economy. It usually takes 18 to 24 months. So even the first rate hikes that we did earlier this year, we don't even know the full impacts of that yet, right? So it's very prudent to take a pause here. I was listening to the commentary from Jerome Powell after the FOMC meeting yesterday. I think there's a lot of information there. I think the big news item was that even though he hinted at slowing down the pace of interest rate hikes, what he did was he revised the dot plot. So the dot plots is obviously, the expectations of the Fed the Fed members and where they expect interest rates in the future. So everybody's been focused on the 2023 terminal value. So prior to the meeting, the terminal value was at 4.6%. That was revised higher to 5.1%. So I think the key here is that he's hinting that the pace of interest rate hikes may slow down, but he's raising the ceiling. So if if inflation starts to pick up again, especially with China opening back up, that gives them the leeway to bring back jumbo rate hikes if needed.
Okay, so not the clearest of messages there. Now, what's your opinion on, and what are the indicators telling us in terms of whether there's going to be a recession or a longer lasting recession?
So I think that's the concern that a lot of investors have right now. I mean, when you look at the yield curve in Canada, especially, so this is what we charted out here. This is the difference between the 10-year and the 2-year. The biggest inversion we've seen in a very long time, so since the 1990s. So, that's obviously a very bearish signal. It's not good for the economy. It definitely does suggest a recession is underway. But, I would say in terms of whether we get a soft landing, that's the big question that I think a lot of investors are concerned with right now. I think everybody has come to grips that we probably will face a recession if we're not in one already. But I think, the chance that we get a soft landing is that when you look at the labor market's been very strong. But also when you look at retail sales has come down significantly. So I think a lot of investors and economists, they're overly focused on the labor market because, it's still very strong. They want to see people, essentially, lack of a better term, lose jobs or get laid off. And that's essentially a sign for potentially lower inflation. But I don't think we necessarily need that. I think we need, it's a good sign if people keep their jobs, but if they spend less, I think that is going to be disinflationary. So that potentially is the catalyst for a soft landing.
All right. So we should tame our Christmas spending now, is what you're saying.
That's right.
Try to cool this off. All right. How it seems like the rate hikes in Canada and the US have sort of been following the same path. Is there one economy that's more sensitive to these type of rate hikes? And are they going to keep up the same pace together as we go forward?
That's a good question. I think there's a number of things there. So when you look at it on the surface, I think the Canadian economy definitely looks like as if it's, typically more rate sensitive. Just when you look at the makeup of the economy, we tend to be made up of things like commodity producers, energy producers. Also our banking sector tends to be very cyclical in nature as well. Even when you look at, the types of business that our banks do. So, investment banking for, commodity or energy related companies, that tends to be very cyclical. So when interest rates go up, it typically is more, has more of an impact on the Canadian economy. But when you look at the equity market, it's been very different, right? So when the US market has actually underperformed the Canadian market this time around. And the major reason is because, the US market tends to have more exposure to the tech sector, and the tech sector has been very rate sensitive, right? So a lot of growth companies that rely on leveraging up their balance sheets, as the cost of debt has become more expensive, a lot of these higher growth technology companies have been more heavily hit by the rate hike. So the equity markets has definitely suggested that the U.S. market has been more sensitive to rate hikes. But in addition to that, I think you also have Russia and Ukraine, which is muddying up the picture a little bit, just because with the energy shortage, that's definitely been more beneficial for the energy sector, which has definitely helped the Canadian equity market, I think.
Yeah, very interesting. That's good. Okay. And then in terms of the impact to markets, what's the impact of these announcements, and how can investors position their portfolios given all of this?
Yeah, I think you hit the nail on the head earlier. You said it's very mixed. So that's the way the market's been absorbing it right now, because I think on one hand, dialing down the pace of interest rate hikes, I think that's a good sign for equities and bonds. But on the flip side, when you look at the terminal value, and terminal value is going up, so on the flip side, that's a very hawkish signal as well, right? Overall, I think leaving the door open for a pause in interest rate hikes should be positive for risk assets in general, so equities and bonds. The challenge, however, is that when you look at interest rate levels, so when interest rates tend to be higher for a longer period of time, people look at fixed income, and let's say if you're getting a 7% yield to maturity on investment grade fixed income, so we're not necessarily there yet, but let's say we get a 7% yield to maturity on investment grade fixed income. People will say, well, typically I get 7 to 9% in equities. I may as well just take fixed income and guarantee or have more certainty in that 7% return and over allocate to bonds rather than equity. So in the 80s, that happened when Volcker took helm of the Federal Reserve. So when interest rates were higher, PEs were more compressed. Equities traded at a lower valuation level just because people required more of a premium to move into equities. But at the same time, just because interest rates were higher, growth was more limited, so earnings became lower for equities as well. So I think, if interest rates move higher and remain at a more elevated level, that should be very favorable for fixed income, which, is a big change compared to the last 10 to 20 years, right? Because equities have been in favor. So this could be a pretty big shift in terms of asset allocation, I think.
Interesting. So you might see that fixed income ETF trend continue into next year. We'll have to see. All right. Well, thanks for that, Alfred. That was a quick session today, but a really good update on terms of what's going on with the central bank policy and this fight to cool inflation. So that caps off a great year of ETF Market Insights. I want to thank each and every one of our viewers for helping to make this channel such a success, for your questions, for your feedback all year long. I hope you continue to watch as we head into next year, and I wish you all a very happy holidays. We will be back, but we'll be off for the next 3 weeks. So we're going to be returning on January 13th, same time, same place. The topic is still to be determined, so stay tuned for our weekly email prior to that. But thanks again for joining us. Have a great holiday, and we'll see you in the new year. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.